Please like and subscribe.
Does tokenization solve, and how does it promise to improve the future of finance?
Yeah, well, tokenization solves a lot of problems. I mean, there's an efficiency aspect to it. You can have real-time settlement, lower fees. But maybe the most powerful part of it is just democratization of access to investment in high-quality products. You know, a lot of people have heard about the unbanked. There's actually an unbrokered segment of the world as well. There's about 4 billion adults who don't have access or any ability to invest in high-quality assets, like the U.S. stock market or, real estate or whatever. So what tokenization can do is, it's just like, you have an underlying unit of that asset. You now have a token that's one-to-one representative of that. The first version of this was stablecoins. That's another version of tokenization. So stablecoins have been growing enormously. We're now seeing that happen with U.S. equities, real estate. It'll happen with corporate paper, commodities, like all kinds of things will come on chain. And this is just going to allow the people of the world to participate in this engine of wealth creation, which most of them don't have access to if they're only dependent on their labor for some source of income. So it'll be a great boon for capitalism. It'll create more demand. When we speak with funds like at BlackRock and Apollo, they've said they want to tokenize every single fund that they have, and they just know that it'll increase demand for their products. So Coinbase launched a product called Coinbase Tokenize, which is helping institutions do this, and we're incredibly bullish on it. If I can make one other point, just to build on what the central bank governor here said earlier, I do think that stablecoins are going to play a major role. I think central bank digital currencies can also play a complementary role. And, people think about our current financial system as kind of sacrosanct and it's the only way to do it. But, if you study the history of money, really it's got created in like 1971 when Nixon went off the gold standard in the US, and we currently have the system where most central banks don't have any link to a hard commodity underneath. I think fiat currencies are going to continue to exist for a long time, but we're also seeing the birth of a new monetary system that I would call the Bitcoin standard instead of the gold standard. And in the crypto space, that is a return to sound money and something that is inflation resistant, because democracies around the world, once we came off the gold standard, are struggling to balance their budget. They're all running deficits, and it's caused inflation in fiat currencies. And so there is a real segment of the population that is looking for a new system based on hard money.
Brad, on that note, there are lots of sound bites there, lots to respond to. You're already seeing the momentum. First up, tokenized assets on Ripple's XRP ledger surged over 2,200% last year. Just weigh in from your perspective.
Well, I think I agree with a lot of what was said here. I do think the first poster child of tokenization was really stablecoins. You saw, as Brian observed, massive growth last year. I think, went from, in 2024, $19 trillion of transactions on stablecoins. Last year in 2025 is $33 trillion, so about 75% growth. I think many in our industry would say that's going to continue. I think to the extent there's space between what Brian was just talking about and how I think about the Bitcoin idea of a Bitcoin standard, I look at that and I think it's much more of the marriage. Sovereignty of fiat currencies, I believe, is for many countries sacrosanct. Ben Bernanke spoke at a Ripple event many years ago, and he made the point that governments will roll tanks into the street before giving up monetary supply, giving up the control of monetary supply, which stuck with me as, yeah, that makes sense. And so at Ripple, we very much focus on building the bridges between traditional finance, as Bill was describing,
much more sensible,
what we now call TradFi, and decentralized finance. And that has meant working with a lot of the banks around the world to kind of build those bridges.
Left the gold standard, but the gold was only a technical mean. What is important is what you say, Brad, that regulation is not the enemy of innovation. Once more, it's a guarantee of trust.
It's fascinating that you say that. Brian, you mentioned a complementary role that you could play. Is there a complementary role in Europe when there's so much regulation and it is about the digital euro?
Yeah, I actually think these are very positive sums. So crypto just broadly is a technology to update financial services. So it's going to help with stablecoins and tokenized equities and crypto assets and trading. And by the way, borrowing and lending is also getting updated. So I think that crypto is very good for fiat currencies. It's very good. Bitcoin is good as a check and balance on deficit spending, because when there is a lack of trust, or people, from like in a U.S. context, if people are worried about inflation, or maybe in places like Argentina or Turkey or Nigeria, they are going to flee to the thing that they believe is going to store value more. So I think in general, it's going to be very complementary. And like you said, I think it comes down to trust.
There's an element of trust, but there's also an element of momentum. We're seeing it in terms of the swing away to gold, which is now just a momentum trade as trust is eroded. Brad, do you want to come in on this in the element of trust?
Well, I certainly think momentum is a big part of this. And I think, frankly, I personally think the crypto environment and stablecoins included, and even tokenization, but momentum is so much on our side of that direction. And that's partly because you're seeing the U.S., the largest economy in the world, has been pretty openly hostile towards facets of crypto and blockchain technologies. And that has shifted dramatically, starting with the White House, but certainly, the work that the industry based in the U.S. has come together and helped elect a much more pro-crypto, pro-innovation Congress. And you're seeing that play out. So I think momentum is a big part of this. And continuing to make sure that we're playing into that in a nice way, but also demonstrating real results. Because, look, if this is just hype, I think part of the tokenization topic, the main topic today, part of that is we shouldn't tokenize everything just to tokenize something. There has to be a positive outcome of efficiency or transparency or, some of the root benefits of being tokenized. Otherwise, it's just okay, it's a nice science experiment.
The attractiveness of the asset also in some parts comes down to yield. And it's funny, gold's been so attractive, but doesn't pay a yield. There's a fight brewing stateside around regulation. And I know, Brian, you've had issues with the Clarity Act, and now it's stalled thanks to some of your opposition. You've been talking about whether there should be a reward paid for some of these tokenized assets, almost like a dividend. Just explain that notion to us, because the Chinese are pushing ahead with a revamped yuan that pays some sort of a dividend. Why is it necessary, in your view? Is it just pushing the agenda for Coinbase, or is it good for consumers?
Ooh.
Yeah, so the legislation in the U.S. has been making good progress on market structure, and I wouldn't say it's stalled. I'd say there's a good round of negotiation happening, and so I think that that's positive. What we shared publicly was that we want to make sure any crypto legislation in the U.S. does not ban competition for traditional financial services, banks, or traditional securities brokerages. And in our reading of the draft, that's what it did. It actually unfairly penalized crypto companies. We think they should be able to compete on a level playing field. And when there's competition, that's how the consumer benefits. And I think there's very forward-thinking bank CEOs like Bill Winters and others that have just really been leaning into this as an opportunity. They recognize change as, you can think of it as a threat or you can think of it as an opportunity. So the smartest bank CEOs are leaning into this. Some of their lobbying organizations in D.C. are trying to put their thumb on the scale and ban their competition, which I have zero tolerance for. So we're going to speak up if we ever see that happening. But yeah, I think there's two main reasons why, in this case, the main debate is around stablecoins paying rewards. First, it just puts more money in consumers' pockets, right? So I think people should be able to earn more money on their money, right? That's the high level. It's also about global competitiveness, though, like you said. China did just come out recently and say that their central bank digital currency is going to pay interest, okay? And then there are offshore stablecoins that are actually larger than the U.S. regulated ones right now, and they would love it if U.S. stablecoins were banned from paying rewards because it allows them to flourish offshore. So we need, from a U.S. legislator point of view, they should be ensuring U.S. regulated stablecoins are competitive. Same thing from a European stablecoin point of view. I hope Eurocoin and et cetera continues to grow. And we're in a global competition. We need to make sure that consumers benefit, and each country puts their interests first.
Governor, to that point, does the digital euro need to pay some sort of an interest?
No, the answer is no. In our case.
Why?
No. Let me explain, perhaps with a somewhat philosophical remark on this apparent opposition between innovation and regulation. Because I'm a bit fed up with this opposition. Let me explain. There is this idea that Europe would be only on the regulation side and innovation only in the US. There is an apparent contradiction, I agree. But there is a common purpose in the long run, which is trust, and we mentioned it. Regulation without innovation, I am not interested. I say to the central bankers, this would be status quo, statism, I'm not interested. But innovation without regulation, it could create serious trust issues. Financial crises exist, and they are born sometimes of misleaded or dangerous financial innovations. And financial crises have a very high cost. This is why we need regulation. So I think it's common interest to find the right balance. On this question of remuneration of stable coins and or CBDC, we have a look at the effect on financial stability on the banking system. I don't want to enter the US debate. We see where the interests are. There are also private interests. They are legitimate. But the public purpose should be also to preserve the stability of the financial system. In our case, CBDC, and especially the digital euro, is not intended to attack the banking system and its deposits. So we should be cautious on the transfers. I strongly believe in complementarity on public-private. And this has been the monetary system for centuries. It's a change of technology today, but it's not a change of principle.
Right. Brad, come in on this, because you're the innovator in the room, but you also believe in regulation.
Yeah, I think what's going on in the U.S. right now it is a classic dynamic of when you create new law, it's never going to be perfect. And I think what's the dynamic within the industry and working with Congress has been kind of I subscribe to the idea that perfection is the enemy of good, and you can't get to perfection. And so I think Brian's exactly right. We're as close as we've ever been in providing that clarity. As some in the room probably know, Ripple lived through a 5-year battle with the U.S. government being sued because of the lack of clarity. So we are very much an advocate of clarity is better than chaos. So, look, I think Brian's right. We are very close. I don't know if we stalled.
But what about the reward side? Rewards, dividends, interest, is it necessary on stablecoins?
Ripple doesn't have as much of a dog in that fight as others in the industry. And so there's others that have stronger opinions. It doesn't directly affect Ripple's business as much. I agree in some ways that, look, competition is good. And I agree very much with the idea of level playing field. Now, I also think a level playing field goes two ways, in that crypto companies should be held to standards that banks are, and banks should be held to standards that crypto companies are in order to compete. So I don't think that's a one-way street, that somehow Team Crypto gets to have a certain pass in some way.
Bill, let's hear from the banker in the room. There's pragmatism. Money goes where there are returns and where there's the best option. Your bank also operating big corridors across Asia as we talk about digital yuan, as well as in Europe. So how do you see this playing out? Do any of these tokens need to have some sort of an interest-bearing element?
I think if I can be very simplistic about it, I think tokens are going to be used for two things. They'll be used as a medium of exchange. No particular need to bear interest for a medium of exchange because they'll be instantly transmitted, and they'll be used as a store of value. And as a store of value, they're much less interesting if they don't carry a yield. But there will be tokens that are called stablecoins. There'll be tokens that are called tokenized bank deposits, which will probably bear yield, and there will be tokens that are called tokenized money market funds, which will definitely bear yield. That's the whole point. Right now, stablecoins are big and liquid, super. The CBDCs don't exist yet. In a commercial scale. Maybe they will. I hope they will in the right form. And tokenized money market funds, of which we've issued in currencies like Hong Kong dollars, or eventually it'll be CNH, Chinese currency, will exist. And they will be useful as a store of value. And our research estimates, everybody's got their own numbers, and maybe we'll get to $3 trillion of outstanding stock of stablecoins in the next 3 or 4 years. The bulk of that is going to be in developing economies where there's lack of confidence in the local currency, and stablecoins of whatever form, it could be Bitcoin, will be used as a store of value. Bitcoin's quite volatile. Everybody knows that the US dollar is the US dollar. You like it, you don't like it, but you know what it is. So that money is going into stablecoins today. It may go into tokenized money market funds in the future if they're available and if they're bearing yield. Frankly, we don't care. As a bank, we don't care. We want our customers to get the best thing for them. So if it's the medium of exchange, we want to provide them with the entry point and the exit point. And we do that today. They like us for it, and we'll keep on doing that. When it comes to store of value, especially in emerging markets, got to be compliant, right? There's probably a black market transaction someplace that gets that local currency out of the local currency into US dollars. Sometimes it's legit, sometimes it's not. That's always been an issue. And as a bank, we're a policeman. That's our job, is to try to prevent that. Unfortunately, banks don't prevent most financial crime.
Valerie, come in on this, because we've spent all week talking about European competitiveness. And if we're talking about different regulation, different approaches here, is Europe going to be left behind?
I'm an optimistic person and I'm a European. So, I don't think that Europe will be left aside, but Europe has to accelerate. I think and I think 25 has been a year where everybody realized that there is a need indeed for fair competition, for a level playing field, but also for acceleration in innovation. And I think there is a willingness in Europe to do so. And again, in my field, which is securities business, Euroclear as a global footprint, we have been pioneering on the issuance of digital assets about 4 years ago. We start also seeing the value of tokenization for probably collateral management, because one of the, I think the thing that we are really adding to the financial market is liquidity. And if you can start, increasing the liquidity, the movement of the collateral management through different pools of liquidity, that will also again benefit the whole capital markets.
Right.
So to your point, no, I think Europe has to indeed innovate faster, but at the same time, I think there are a number of banks, there are a number of financial market infrastructure, there are a number of players who are definitely willing to be part of that game, and we will be at the rendezvous.
Just a quick one, Brian, before we open up to the audience. Is there a geopolitical element here? We've got so many stable coins backed by US dollars. You've got the yuan moving at pace as well. The reality of the future, if there's more transactions in both of these currencies bypassing other elements, does that have consequences for the relevance of, say, the euro and other currencies?
I do think that they're in global competition. Absolutely. China, US, Europe, going down the list, Japan. I mean, in some ways, Europe is ahead of the US because they passed MiCA legislation. So they have comprehensive crypto legislation, while the US only has about half of it done right now with the Stablecoin Act. And we're now working on market structure. So Europe is ahead, but the vast majority of stablecoins are actually US dollar backed still. And so, when I meet with leaders in the Europe, I basically encourage them to move faster, allow some of these things like rewards on stablecoin, which is different than interest and yield, that would allow them to be globally competitive. So I do think Europe, I'd like to see them move faster on European stablecoins.
Governor?
No, I think on this question of sovereignty and geopolitical balance, first, we are all from advanced economies. And this is perhaps missing in the panel, because this development of tokenization, you mentioned it, Bill, is probably an increasing challenge for some developing countries or emerging economies, because it could mean a full dollarization. Let me put it this way. On the other side, it will bring serious economies, cost savings, on the cross-border business. And this is a huge benefit, I hope, for the developing world. But here, obviously, the worry about tokenization is bigger in the South, to put it up. And we had discussion in the G20 by some very important emerging countries, emerging powers, saying we should forbid.
Okay, Brad Garlinghouse is about to take some questions from the live audience. Can everyone please hit the like button? That would be great.
If I may add two other points. On your point, Brian, I agree that tokenization is probably an accelerator of the diversification of the monetary system and diversification of currencies. At present, most stable coins are in dollar for a very simple reason. It's linked to the main use case, which is crypto exchanges. But if we come to financial transactions, and still more to economic transaction, your prediction, Bill, I would be ready to bet for 28 for financial transaction, not less for economic, but we'll see. But if we move to these other use cases, we will have this diversification. Right. And here, infrastructures will matter much. I agree with Valérie. This APIA project I mentioned is ready to ID to build an integrated infrastructure in the European market. It will accelerate capital markets union.
Now, we're going to take some questions from the floor. So if you do have a question, just put your hand up and we're going to bring a microphone down to you. Just in the meantime, to our online audience, remember you can get involved. Hashtag WEF26. I think we've got a microphone here in the front. If you want to pitch a question directly to anyone on the panel, please feel free.
Yes. Oh, stand up? Okay. So, hello. Thank you very much. Fantastic panel. My name is Fernando, but the chief economist of a big Brazilian bank. So my point is, what do you think would happen with credit leverage, with duration transformation and monetary policy in a world where stable coins win the game? Let's say it this way. Just would love to hear your views. Thank you.
Governor?
Very simple question. You come from a Brazilian bank.
Yes.
You said Brazil is a very interesting example where, as you are aware, at present, the Brazilian central bank developed a fast payment system, which is probably the most efficient worldwide, with PIX. And there is now the idea of extending this infrastructure also to a kind of CBDC with drugs. So if stablecoins only win the game, this would mean, it's an extreme case, that money would be completely privatized. I wouldn't be completely reassured, to use a euphemism. We had in the past, again, technology doesn't change the philosophy. We had example in the past where money was completely private, without a serious central bank. Take what existed in the US in the 19th century under your control. And there was no real Fed or central bank. And there were many crises of confidence. So I don't say at all that central bank currency will be dominant, will have a significant market share, but it's an anchor of confidence.
Right.
And it's why I insist so much on complementarity. I think it's the interest of stable coins to be fully equivalent at par, one-to-one, without fees, to a central bank currency.
Brian, coming quickly so we can take another question too.
Yeah, I would just say in a world where stablecoins grow to that extent, I wouldn't say that they're entirely private money. I mean, in the U.S., at least under the Genius Act, all the stablecoin reserves have to be held in short-term U.S. Treasuries. So they're really backed by U.S. Treasuries, but the privately issued the token. And then I think what will happen is, you mentioned like the transformation or maturation comment. I think that in that world, you're going to have companies that are just have a 100% reserve of people's money held in U.S. Treasuries. There's not going to be a concept of fractional reserve if they don't want to get licensed as a bank, right? And so what does that mean? It means people can earn rewards on those stablecoin balances, but if they want to earn a higher return, the customer can opt in to lending out their money, and that'll have to pay a higher rate than what they could get in short-term U.S. Treasuries. So it actually flips the banking model a little bit on its head.
Right. Another question here.
A much more basic question. Unless I'm mistaken, tokenization built on blockchain technology. Blockchain technology requires compute and electricity. Given the fact that we already have an issue in terms of having enough capacity to cover all the AI that's coming down on us, how are we going to cover all the tokenization that's coming down on us?
Brad, is that one for you?
Sure. I mean, I'll comment briefly. Not all layer one blockchains are created equal. Some use, as you're describing, proof of work. Some use proof of stake. Some use other consensus models. So I wouldn't uniformly put all of the kind of blockchain infrastructure in kind of one power lens. And so I don't think it's as big as a deal. And what you're seeing is most of the activity of stablecoins today is on more power efficient blockchains, either use proof of stake or a consensus mechanism.
Just to add to that, proof of stake uses 99.9% less energy than proof of work,
right?
Which most of the tokenization is happening on Ethereum blockchain, which uses proof of stake.
Another question here.
I'm Armstrong. I'm the founder of the largest payments company in Latin America that's non-bank. I see a lot of countries in the global south that don't control their own currency. Why haven't they been on chain already? And what do you think needs to happen to move their whole payment infrastructure to the blockchain and perhaps to have stablecoin replace like the dollars they use locally?
Who wants to take that one?
They haven't because of the sovereignty concern. And I think most developing economies are still, not all, obviously there's some examples of countries that have gone entirely digital and they've given up the sovereignty of their currency. Others have accepted dollarization and they've given up the sovereignty of the currency. Most are resisting that for the reasons that the governor mentioned at the outset. So then it just happens through the back door. And you end up with a de facto dollarized system. At Standard Chartered, we operate in many de facto dollarized economies. They work. It's not bad at all, actually. But the government has an extremely important lever of power. These are not typically democracies, although they may be in some cases. But the government loses a lever of power to control the destiny of their people, which typically isn't popular with the people. So, but if it doesn't happen through the front door, it happens through the back door. But the better outcome by far is to have a legitimate monetary regime in the first place that's managed by a legitimate central bank. And obviously, many countries in the world have achieved that, not least the European Central Bank. So, no, let's be serious. I mean, like, how many countries have hit their inflation target, consistently over a period of time? I mean, we're struggling with that right now. So, anyway, but you guys are experts, and you're dealing.
Can I only add, on a positive note, I completely agree with what Bill just said, that many of these emerging countries and still more developing economies are very innovative in fast payment systems. So they are more on the infrastructure side than the currency side itself. But I'm impressed by the fact that advanced economies are not the most innovative in fast payment system.
Now, let me
PIX is not the only example. Take UPI in India, take South Africa. There are very interesting things happening on the payment systems.
Right. I want to push on to an issue that impacts Western markets, developed markets, emerging markets. If we have more fractional ownership, does that drive speculation? Because we've seen it in many areas where there's fractional ownership. You've seen it in the retail investor getting involved in many places. You actually have an escalation of that asset class. You think about single homes, and there was an announcement recently from the president trying to keep out institutional ownership. And if you put that together, was that a preemptive strike ahead of some of the changes that are coming in tokenization? Brad, do you want to touch on that? Does it provoke more speculation in asset classes, and where does that leave the average owner?
Well, you're choosing the word speculation. I subscribe to Brian Armstrong's comment earlier of like opening up investment access, and investment versus speculation. I put in kind of two different buckets. They both have a purpose, and they both have active market participants. But I think the opportunity around tokenization for certain verticals is, in fact, the democratization of access to investment, less so on the speculation side. I don't know enough about Trump's decision to make steps towards banning institutional investment in residential real estate to comment there. But I do think if you want economic exposure, investment exposure to a commercial building in Miami, and you have $10,000 US, you can't do that today. And I think opening that up, and I know Brian's example is even better because it's the many billions of adults who don't have any access. My example is not perfect for that, but you get the point.
Bill?
Look, investments are speculation, two sides of the same coin, versus transparency. Right? So when you have, in a fractionalized world, you'd have much more transparency. Transparency is typically good for systemic stability in the long run, although it can lead to bubbles or bouts of short selling that induce volatility. On balance, I think where we've had nasty financial crises, they've been when there have been problems that some in the market have seen but couldn't act on and couldn't normalize that. So I would always vote for transparency. Fractionalization should lead to transparency.
Governor, 10 seconds.
No, just to say that yes, to increase access to investment, as you said, but it must go along with increased awareness of risk. And this is the question of advice by the financial industry to their customers and financial literacy. So it should go together. If not, it could be a catastrophe at the end.
Valerie?
I completely agree. I think it's two sides of the same coin. I think it's also according to the risk profile of the people, but access doesn't mean speculation necessarily.
I'll take a different take, which is I think the top 10 fiat currencies of the world will have enough trust to persist, and the next 100 should either get dollarized or replaced by Bitcoin.
And on that note, we are right at time. Thank you so much.
We are definitely missing a developing country.
Thank you so much to our terrific panelists. We do appreciate you weighing in. I think we've all learned a lot about tokenization, so we do appreciate it. Remember to get involved, hashtag WEF26, although I'm not sure if we're still hashtagging anymore. Brad, are we still hashtagging?
We're still hashtagging.
Okay, we're still hashtagging. Thank you so much for joining us.
Live 24/7 Bitcoin and XRP graphs. Join our channel.